one-on-one counseling for sure.
Okay. Mm, Ospiedade.
All right. So, ladies, if you guys kind of want to give a breakdown of what you guys do, and then I'll just jump right into it. Everybody else, I'm recording it so they can catch up or get it later, but I want to be respectful of everybody's time. So, Carol or Yvette?
Okay. You want to go, Yvette? Oh, she's going to let me. Okay. So my name is Carol Harris and I work for Prosperity Connection. Basically, if you are looking for assistance with one-on-one coaching to help you in your home buying process, maybe you've got some things you need to check out on your credit report or, get things cleared up as you're getting yourself prepared for your home buying adventures, you give us a call and we can set that coaching up. Plus, we offer lots of classes like this one. And we also put those classes up on our YouTube channel as well. So we'll put that information in the chat so you can grab that and look that up later. You can see Kris has taught many classes that are on our YouTube channel. He's turning into a YouTube star. And actually, one of his home buying classes is one of our highest viewed videos of all of our videos. But every class that we teach is on there as well. So check that out. And I think Yvette will put that in the chat probably while I'm talking. But if you make that call to Prosperity Connection or you go to our website and you click on, you want to, talk to somebody, you actually get me. Even though it appears that I'm working from home, which I am, I still answer the phone. I still check all the email and set up those coaching calls and can help you navigate to sign up for classes. So our classes are wide range, like budgeting or just credit. We also have St. Louis Builds Credit, which is another piece of our organization that can specifically work on that as well. So Yvette, did I miss anything? No? Okay, so we will let Kris get started. And if you have questions, put them in the chat. And Kris is really good at navigating everything. He's probably got 10 screens up there for all we know.
Only
but we'll
five
try
right
to
now.
5. Okay.
Yeah, 5.
So, but we'll try to, if he doesn't see your question, we're looking at the chat as well and can help you out with that as we go along.
And then at the end, I'll unmute or ask everybody unmute so you can actually ask me the questions as well. But I kind of muted everybody right now just so we can kind of get through. But my name is Kris Mills. I am with People's National Bank. I am a local lender here, but more so than a guy that actually just does loan. I'm what they call a community development person. My job is basically helping people who are not able to get finance, make them financeable, and renovate neighborhoods that need to be renovated without actually gentrifying. So I got a big task ahead of me because if you kind of Google and do some researches, there's been no cities that have had revitalization without gentrification, which basically means the city has been improved, but the people that were there before are still there. That just doesn't happen. So, but I have a way to combat all that. So what I'm going to be doing this evening is kind of give you guys a 30,000 foot view overview of basically lending, down payment assistance, credit, and the biggest thing in all of this is budgeting. So if you cannot manage your money, you should not be jumping into wanting to buy a home like in 30 days. It's not saying you shouldn't start the process, but don't think that you've never had a written budget in 30 days. Boom, I'm gonna go buy this house and everything's gonna work out right. It could, but what you can do and what you should do are two different things. So let me share my screen and I'll get started. to you like this. Can everybody see my screen? Just put a yes in the chat or thumbs up or anything else like that. All right, cool. So this is all my contact information here, and I can actually email all this out later to you if needed. And the agenda. So the things we're going to cover is why should you own a home? The cost of renting, and there's actually a cost of you paying rent each and every month without getting any benefit for it. Financing the home, the different loan options from FHA, VA, regular portfolio loans with the local bank like we have, and then our loan, which is the Building Communities Together loan, which is not actually based on credit score. So the first thing is, why should you own a home? And it's very simple. Why you should own a home is called appreciation. Basically, how to build generational wealth by using the asset of a home. So if you kind of look at a historic appreciation between 91 and 2005, on average, homes in St. Louis area appreciated anywhere from about 1.9 to about 3% per year, meaning when you buy a house, each year its value should increase for you, while at the same time you are paying down your mortgage, and then that difference in between is called equity. Equity is your money. So to give you a practical example, if you were to buy a home that was worth $100,000 in 2010, right now it should be worth approximately $123,000. At that same time, you were paying down that mortgage balance of $100,000, so it should be somewhere around the $80,000-$90,000 range. So that difference between what you owe on your mortgage and what it's worth is actually your equity. So if you were to sell your property, you can have that money in cash. You can do a refinance and take some of that money out and pay off other bills, do home improvements, do whatever that you need to do with that. Home appreciation is a slow growth to how you actually build wealth. You can actually improve your net worth, which your net worth is a simple calculation. You take up all your assets, meaning everything that you have money wise, 401k, stocks, assets, and your bank account, savings account, and then you subtract that against your liabilities. That gives you your net worth. Most cases, a lot of people have what's called a negative net worth, which means they have way more liabilities than they have assets. So buying a home actually helps you increase your net worth. And like I said before, this journey, all this is a business deal. So I want people to take that into account. When you go into buy a home, I don't know anything else you're going to buy that's worth 50, 80, 120, 150 up to $200,000. So you better have all the information that you have on it. So the first thing is, if you're renting, there is an actual cost of renting. And these numbers have actually kind of increased since COVID. This is in the St. Louis City area. If you were purchasing like a regular 3 to 2 bedroom house for rent, it'd be about $868 per month, meaning for the home that you rent or the apartment that you rent, you're shelling out, let's just call it just about $900 per month. You do that for 5 years, that is an approximate $52,000 that you have just given away in money that you are not getting back. It has no benefit to you whatsoever. It has benefit to your landlord. You're helping them improve their equity position and their net worth position. But as for you, that is just money that you're never going to get back and never have a benefit for. So assuming the rate was 4.5%, which is about 1% higher than what it is right now, and then appreciation over 5 years, you would actually come out anywhere between 30 to 50,000, depending on where your home is. Appreciation is a little bit different. Homes appreciate in St. Louis City different than they appreciate in, let's say, Chesterfield. So when you hear me talk about financing, I actually talk more about what you're approved for payment wise, because that payment is going to be fixed no matter where you buy. But if you're wanting to buy something for 100,000 in St. Louis City, that payment is going to be different than if you were to purchase in Hazelwood because of the real estate taxes and the homeowner's insurance. So the amount that it appreciates is going to kind of vary depending on where you purchase and stay, and also the amount of the payment. Even though it's 100,000, it's going to be a different payment depending on where you guys are going to be purchasing. So the equity is the biggest thing that you guys get out of a home when you want to purchase it. So the equity is the difference between what the home is worth and what you owe, and that is actually your real money that you have. So other benefits that you get from owning a home is you get tax benefits. It's probably going to be one of the single most biggest breaks that you guys get, because right now you guys have the child income tax credit, all these other credits that you get, but the interest that you pay on your home is tax deductible. Some of the closing costs is tax deductible, and then home improvements in some cases are also tax deductible. So you talk with your tax advisor on all those. So everyone know we're still in a historic rate low. Even though rates have basically climbed steadily the last 5 weeks, it's still lower than what the national average has been for the last 30, 40, 50 years. If you were going to get a loan, let's say in 1980, 1990, and you had an 800 credit score with 20% down, you were paying this 7% or above easily. And that's with perfect credit. So what this means for you for buying a home is the lower that interest rate is means the more home that you can buy. Because this interest rate is lower, that payment that I was talking about, the payment that you're allowed to have is actually going to allow you to buy more of a home, because a home that was 150,000 at 6.5% is going to have a much higher payment than a home at 150,000 at 3.5%. So people always ask, is this a good time to buy? Yes. And the reason for that is a couple slides ago, you saw how home values tanked back in 2008 through 2010. Home prices are starting to increase right now, but a good offsetting factor to that is the interest rates being low. Eventually, home prices will go back to where they were, and interest rates will go back to they were. When those go back to those levels, you'll still be able to buy, but your purchasing power is going to be way less than what it is right now. So basically, the longer that you wait, it's potentially going to affect how much you can buy. So the interest rates being low, right now they're right about 3.5%, even with them increasing steadily over the last 5 weeks. So interest rates being low right now is still a very significant thing. As I mentioned before, you can deduct the interest on your mortgage that you pay annually from your income taxes, the property taxes, and in any home improvements. So the first thing, what happens, like, you guys want to get credit anywhere, any institution. The first thing they're going to ask you for is an application, meaning they're going to want your personal information. They're going to be asking you things for like your name, your date of birth, social security number, I-10 number. If you don't have a social security number, but you have an I-10 number from the IRS, ask you for a valid ID, appointment information, and your last 2 years of where you stayed at. All this is so they can pull a credit report to determine your payment history and your debts. We are going to look at your history to say, how have they paid this person in the past? It's going to be a good indicator how they're going to pay us. So in the last 12 months, we're going to look at if you have any late payments, charge-off, collections, judgments, bankruptcies, and if so, the reason why behind that. We're going to look at the snapshot 36 to 48 months before then, the last 12 months, and kind of make a determination based on risk. Think about it this way. When you come to a lender, you basically need to make them feel good about giving you money. They have all this money, they have all these applications. The only way they can make a determination is basically what you put on paper in front of them. And the first hurdle, I equivalent buying a home like a hurdle race. So the first hurdle for most people out the gate is credit and credit score. So if you don't have, in today's COVID world, FHA and VA for most lenders across the country, you have to have a minimum of a 640 score. So if you don't have a 640 score right now, you're out of the game. You can't even possibly have a chance to get qualified. So that's the first hurdle that you look at, and the charge-offs, collections, judgments, tax liens all correlate into that. What I want to point out to you is no matter what loan programs you have, if you have a certain amount of collections, like for FHA, if you have over $2,000 worth of total collections, no matter how old they are, FHA will either number one, you either have to add 5% of the outstanding balance of all those collections and add it into the debt to income ratio, or pay off enough to where you're up under that 2,000 threshold. The difference between the charge off is from a collection is it went into collection first. You had an account, let's say you had a credit card. You got 4 months behind. They try to call and collect for the 4 months. And then eventually it goes to charge off status. Basically, that company is saying, we don't believe we're ever going to get any money from this client anymore. We're going to write it off our books as a bad debt, and it becomes a charge off. In most cases, charge offs do not have to be paid off unless it's probably a car repossession. Those are the kind of tricky ones. This judgment kind of happens either in between the collection and charge off payoff, or it could happen after. So a judgment is you got an account and went into collections, they tried to collect and they never got their money. They will then petition the court to have you actually pay them with the judgment, either through garnishments or anything else like that. So if you ever get a letter stating that you got to go to court because of a debt that you owe, at least show up to court. Because if you do not, they're going to do what's called a summary judgment. You could have a debt that's actually worth $2,000. You don't show up to court. That creditor says you owe me $4,000. That judge is going to do a summary judgment. You owe $4,000. There's going to be no ifs, no ands, no buts about it. You're going to have to pay that $4,000 eventually to either get a house or something. It's going to stay on there until it's paid. It may not show up on credit, but it could show up on the title work when you get further in the process. When it comes to tax liens, what we're looking for is, most importantly, federal tax liens from the IRS. We don't want any type of lien that could possibly supersede us from us basically getting our money first. So we as the lender are lending you $150,000 and you have a tax lien for the IRS for $15,000. We do not want them to leapfrog us into the first lien position, because lenders and bankers, they default to a worst case scenario. If worst case, they don't pay us back and we need to foreclose on, we want to make sure we get our money back first. So we don't want the tax liens there to potentially be in front of us to negate how much money that we get. And then we're looking for bankruptcies. If you had past bankruptcies or if you're currently in a bankruptcy. When it comes to the debts that we're looking at for everything that's currently showing up: car loans, student loans, whether they're actually in repayment or not. So right now, pretty much everyone's student loans is in forbearance right now. Even if it's in forbearance, FHA, conventional, and VA will make you count 1% of the outstanding balance of that student loan, no matter what, unless you were in an income-based repayment plan before COVID hit. And then you can use that income-based repayment plan on conventional and VA. FHA doesn't matter. You have to use 1% of the outstanding student loan balance for FHA, no matter what. We're also looking for tax liens. So this might not show up on credit and this might not show up on the title, but if we get your bank statements and we see that you're paying the IRS regularly each month, or state of Missouri or somebody else like that, that will actually be counted as a debt, along with child support, credit cards, other debt, like we may notice they're coming out of your bank account. So we'll get at least 2 to 3 months of your bank statements, and we're literally going to go through line by line and look at everything that you spend your money on. And if we see reoccurring debts that's not showing up on credit, we'll ask you about it and see if that is something that's actually reoccurring or not. I see a question here. Hold on. Is this meeting for homes purchased in St. Louis City, St. Louis County? Once you get an approval, you can actually purchase anywhere in the country. The only loan that is specific to where you buy locally here is the no credit score program. It has to be within a 100-mile radius of St. Louis City. So I hope that answers that question. This is a big one here. Recently acquired debt. Once a lender or anybody pulls your credit, there's going to be a section on there that says recent inquiries. So we're going to look to see which lenders, which creditors actually pulled your account. We're going to ask you, did this credit inquiry lead to an updated or new account? And you have to actually sign a form that says yes or no, because you could buy a car last February. Only the inquiry will show up on your credit report if I pulled it today. So this kind of gets a lot of people in trouble along with lenders because they don't ask the question about that recently acquired debt. Somebody goes gets a contract on a house, and the lender then asks them about the Lou Fuse credit inquiry, and they got a car payment that's $400. That totally blows up the debt to income ratio if that was not accounted for very early in the process. So we kind of take a look at all these things up front, and there are documents that say, hey, look, do you have any other debts? And if you say no on those forms, you're basically committing fraud, and then you'll have all the alphabet people coming to talk to you, FBI, people that you don't want to be talking to. So I say this in all seriousness. Tell us up front what your problems are so we can address them. I've been doing this a long time. I'm not over 20 years, about 25 years. There's not a situation I have not seen personally, been through personally, helped somebody through, or had a colleague go through. It would be awesome if I got a new situation. You know what I'm saying? Because it'd be a new problem to solve. But there's pretty much all the same problems, just the circumstances around it which change. So the next thing we take a look at is your income. So we're going to take what your income is versus your debts. That is called your debt to income ratio. So we take a look at your gross income and we divide that by your debts. We look at your salaries, wages, bonuses, Social Security benefits, VA, self-employment, if and only if you have filed tax returns on that business for the last 2 years and you showed a profit to the IRS on that business for the last 2 years. So self-employment is one of those things. Some people actually start a company and claim a loss that first year. We actually have to deduct that income off your salary, your wages, your bonuses. So kind of be careful. I know why the CPAs and the people that prepare taxes claim a loss so they don't have to pay that tax benefit, but it also negates your purchasing power when you want to buy. Pensions, annuities, alimony, and child support. Yes, we can technically take it if you can prove it's going to continue for more than 3 years. I am very hesitant about using that because that is an expiring income. And 80% of the people in this country file bankruptcy because they have a deficit in their budget of $350. And if you're saying your child support is $350 and it's going to end in 3 years and you don't have a way to compensate for that, that is basically setting yourself up for failure in most cases. So it can be done. It's just I would proceed with that very cautiously. And any other income that you actually documented. So if you're a 1099 employee, have money on the side, anything else like that, you should actually tell us about to see if we can actually use it. So when it comes to your assets, basically we're looking for the money that you're going to have during the transaction. This is for the down payment, earnest money, inspection fees for the property, escrows are basically taxes and insurance on the property, and closing costs are all the costs associated with the loan, from the third-party vendors to the appraisal to see how much the property is worth, everything that's associated with the loan, and reserves. So lenders use a nice little trick, say, hey, look, you don't pay any closing costs. This is a business, people. Nobody's giving you nothing for free. You are paying for that loan. You're either going to pay it in the closing costs or you're going to pay it in the rate that you give you. So I guarantee you, I've never seen a free cost loan out there. The only loan that lenders don't usually charge a fee meaning like People's National Bank or USA Mortgage, is for VA loans, veterans. We usually don't charge them our bank fee for veterans because of who they are. And then reserves. Reserves is the amount of money that you have left over after you pay the down payment, earnest money. How many months of a mortgage payment do you have set aside just in case things go wrong? So let me address the down payment and the earnest money. The earnest money is a part of the down payment. So when you actually get approved and you get a pre-approval letter, and that seller asks you for at least $500 to $1,000 down once they accept your contract, this is then subtracted off the down payment amount that you are supposed to have. So when you do an earnest money, you're either going to use a check, cashier's check, or wire the money to the title company so we have credit for that. And then the inspection fees, you're going to have an inspector go into the home and give you a report on everything that's wrong on the property from the roof to the basement, or if it's the slab, from the roof to the slab. And it's going to give you a report that you're going to go back to the seller and say, these things are wrong with the property. Would you please either fix them, give me a credit towards this at closing, or reduce the sales price, or if they don't want to fix anything, you may just walk away and find something else to do. And then escrows accounts. You have to set up homeowners insurance and real estate taxes, an account to pay those on a yearly basis. The only thing in this entire transaction you actually pay forward is insurance. You will pay a full year of your homeowner's insurance in advance. So if you were to close today, that insurance will be good all the way into April 23rd of 2022. And then 1/12 of your payment each month will go towards that. And when March 23rd comes around 2022, we would pay the insurance company. All right, so with all that, once we get the credit, we look at the credit score, and credit scores are breaking down in this pie chart. The biggest chunk is your payment history. How have you paid other creditors? If in this section on the payment history, I can tell you from my experience, what I've seen, if you have a choice to be late on something, if it's a mortgage, car payment, or credit card, pay the credit card payments first, especially if the payment's like 30 something dollars per month. Because the way the algorithm looks at it is you really didn't have $30 to come up to pay for this account. So they could probably understand you missing a $300 to $400 car payment, but a $30 credit card payment here or a 15 credit card payment there, it's kind of hard for it to justify you didn't have that money, even if you were on unemployment or things of that nature. So when it comes to the payment history, paying things on time before they're 30 days late, before they can report it to your credit bureau late on you, is key. The next big chunk is the amounts that you owe. So if you have credit cards, you probably see and if you got a credit monitoring service, you probably see your score go up and down each month. That is because of the utilization of your credit cards. Once you get over 30% usage of the card, score drops. Once you get over 50, drop some more. Once you get over 75, drop some more. Once you get over 90, drop some more. So depending on what you charged and when you made that payment and when it reflects to the credit report, is all going to make a determination. And there's usually about a 20 to 35 day lag from what you've actually charged and paid to what actually reflects on the credit bureau. I tell people all the time, ask your creditors, your credit cards, what day of the month did they report, to make sure that you have your payment in before then so it can reflect the lower payment. The next big thing is length of credit history. This happens a lot with people that are establishing new credit. So they haven't had any late payments, their usage is low, but all their credit history is 12 months or less. So yes, you may have a 675 credit score and you may have 4 accounts open, but all those accounts have 12 months or less worth of credit. There's not enough track history there to really know how you're actually going to be paying that going forward. So the length of credit history has an impact as well. And then types of credit, revolving versus installment. Revolving is a credit card. Installment is like a car loan, student loan. You know exactly how much you borrow. You know what the interest rate is. You know how many payments it's going to be, and you know when it's going to be paid off. And then the last piece of the puzzle is new credit at 10%. That goes back to the recently acquired debt that I was talking about beforehand. When you go get a loan, every lender is going to pull a tri-merge. We're going to pull Equifax, Experian, and TransUnion. And we will use the middle of the three credit scores. So let's say your Equifax was a 650, your Experian was a 620, and your TransUnion was a 660. We will use that Experian score of the 620. The next thing, after we look at your credit, we can kind of determine what bucket of loan that you may go into. Conventional, government, VA, FHA, USDA, or specialty program like our no credit score program. So for right now, to kind of get in the door of conventional, you would need a minimum credit score of 660, and this is just to see if you can get an approval through the system. Uh, Most everyone right now in the country is at a 640 credit score for FHA, VA, and USDA. I can do this down to a 620 right now. So the difference between conventional FHA, I'll do those two, is how much you can put down. So conventional, you can put a minimum of 3% down, meaning if you were to buy a home for $100,000, the down payment that you will be required to come up with would be $3,000 if you were not getting assistance. For FHA, you would need about $3,500. Conventional, anytime for any loan, basically just about, except for VA, USDA, anytime you borrow more than 80% of what the value of the home is, you're going to have what's called PMI, or private mortgage insurance. This is insurance that you pay the lender just in case you don't pay the lender, because they deem it a riskier type of loan. So anytime you borrow anything over 80% of the value of the house, you're going to have this PMI. PMI is fixed at 0.85% for everyone, regardless of credit score on an FHA. It's a little bit more trickier here on conventional, and it goes by your credit score, the debt to income ratio, and your loan amount, and your LTV, how much you're borrowing. So all things equal, sometimes the mortgage insurance will be cheaper for FHA than it would be for conventional. But reason why you still may want to go with conventional is because with FHA, no matter what, that mortgage insurance stays with you for the life of the loan. With conventional, once you get at 80% or 79% of what the property is worth versus what you owe, the mortgage insurance can go away. So if you start off with an FHA loan and you want to get rid of your PMI, the only way to get rid of it at this point would be to refi into a conventional loan, a VA loan, or any other type of loan versus an FHA loan. Rates right now, because they're so low, are pretty much comparable between conventional and FHA, VA, and USDA across the board. There may be anywhere from an eighth or 1.25% to a quarter of a percent, 0.25% difference between the rates. Interest rates and the payment make a big difference once you get over a loan amount of about 150 to 175. Anything up under that, a change in a rate of 1.25% and 2.5%, the math dictates that it's not going to be that big of a difference in the payment. The biggest difference between the conventional and FHA is conventional. If you had a bankruptcy, it's 4 years from the discharge date. FHA, 2 years from the discharge date. If you had a foreclosure, conventional, 7 years waiting period. FHA and all these other ones, it's a 3-year waiting period. So you may have a conventional score with all the trade lines, but you had a bankruptcy 2 years ago. Then your option you have is FHA, VA if you're a veteran. VA and USDA loans, there's no down payment required on both of these. They're both 100% financing without MI. So if you're a veteran, the first loan we're going to try to look at for you is VA. And if we can't get you there because of credit score wise, we kind of look at what we need to do credit score wise to kind of get you there. Otherwise, we may put you in something else until such time we can refinance you into a VA loan. So if you don't qualify for conventional FHA or USDA, or you just kind of want to see what these specialty programs are, and local banks, your local lenders will call them a portfolio loan. Basically, it means People's National Bank, Commerce Bank, US Bank, they will actually lend you money that they've set aside for a particular program uh, from their own bank's pocket. It won't be sold off to HUD, it won't be sold off to Fannie Mae, Freddie Mac, or anybody else like that. It'll be an in-house loan. So most of these are only with banks. You can't get them with a place like USA Mortgage, with another Cornerstone, because those are mortgage brokers. They're not actually bankers. You have to have actually deposits in a bank to be able to kind of lend money in this manner. So I will get to the specialty programs a little bit later, but let's kind of talk about the down payment assistance. So there's three main buckets that I use here. There's FHLB, which stands for Federal Home Loan Bank in Chicago. I am one of the few Missouri lenders that uses Chicago versus Des Moines, Iowa. And the biggest difference is Chicago never runs out of money. Problem with down payment assistance is if you use Des Moines or you use like a local nonprofit like Beyond Housing, Better Family Life, and the Housing Partnership, there's sometimes that there's such a run on the money, they actually run out. And it's been instances before when the market was hot that I had people under contract and we submitted the contract, the assistance was there, but by the time that it came to closing 30 days later, the funds were exhausted and there's just nothing you could do about it. So that's kind of why I like Chicago. I like MHDC because I've never had an instance where they run out of money. So the kind of difference between FHLB and MHDC is FHLB is fully forgivable after 5 years. And after year one, your amount that you borrow starts to decrease 20% each year. MHDC is forgivable after 10 years. And in year five, it starts to decrease 20% per year until you're fully forgiven in year 10. This is the biggest difference between the two, the income requirements. So for FHLB and all the local nonprofits, they make you use the income requirements for based on HUD. And let me pull up the income limit so you can see why that's such a big of a difference. So for a 3-person or 4-person household, you're capped at 66,300. Now this would be for everyone in the household over 18 that's going to be staying there, whether they're on the loan or not. So let's say you and a significant other or spouse, your total income is 71,000, but you only have a 4-person household. You will be over the income limit for Beyond Housing, Better Family Life, the Housing Partnership, and FHLB. But for MHDC, you're allowed to go up to 82,900 for a 1 or 2-person, up to 95,000 for a 3-person household. And then they also have what's called a next step program. If you're over those limits, you can make all the way up to $113,000. So that's why I kind of give options on all of those to pay depending on what your income is like in your household size. So those are the major differences between the income limits between HUD and what MHDC allows. So FHLB and the local nonprofits, they both use HUD. MHDC allows for a higher income limit. Now for FHLB, you technically don't have to be a first-time homeowner, which means you don't have ownership interest in the property in the last 3 years. For FHLB and MHDC, you can actually own another property and have it rented out and still get the assistance. That is not true for the local nonprofits over here. For FHLB, the interest rate is determined by the market rate. So basically, whatever the current rate is in the market, that the market determines is what the rate is. At MHDC, they set their own rate. There's nothing we can do about it. They set the rate if you take MHDC. FHLB is a 3-to-1 match, meaning if you put $1,000 in, they give you $3,000. If you put $2,000, they give you $6,000. and the max that you can have on the debt to income ratio is 45%. The assistance for MHDC is about 4.5%. So depending on what the loan amount you need and stuff like that, the assistance can sometimes be a little bit less. It can sometimes be a little bit more. But if you're doing a conventional loan at 3% or FHA at 3.5%, you're still getting more assistance than what you need for the down payment. And some of that can be put towards the closing cost. Now, the great thing about this is we can stack these. I can use MHDC along with FHLB, along with the Better Family Life. So you can possibly get up to 3 different type of assistance. The only kind of caveat with the local nonprofits is they make you have extra inspections that the seller will have to do that you don't have to do with MHDC and FHLB Chicago. And sometimes when you have a contract, especially in this climate where there's more people wanting to buy homes than there are homes that you can actually have sold, if you have a competing offer with somebody and you have these extra inspections and they don't, it could be a reason why you don't get your contract accepted over there. And then also with the local nonprofits, you only get $3,000 worth of assistance, period. And most of these, you have to have at least $1,000 of your own money into the transaction. So even if I get you all 3 of these assistance, you're still going to need about $1,000 to $1,500 of your own money for the earnest money, inspections, and appraisal. The biggest thing also with the local nonprofits, they have a little lower max debt to income ratio than MHTC and FHLB. And if you have over a 660 score, MHTC will let you go up to a 50%, and FHLB will too in certain instances as well. So now we're going to talk about my specific no credit score program. It is income based and household based on the HUD income parameters that I showed earlier. With this, you also have to be a first-time homeowner. It is for purchases and refinances. It's only for a primary residence, so you cannot own any other properties. It's a 97% conventional loan. It has 15 to 30-year fixed mortgages with no mortgage insurance. Taxes and insurance are a mandatory part of the payment. And we also have a forced savings plan, if you put it that way. It's a neighborhood stabilization plan. So basically, $35 to $50 a month would be put into a savings account for you guys for down the road. If you need repairs or anything else like that, you can go back to the counseling agency that you did your budget counseling with to make sure that it's an actual expense that you need and that you have no other way to pay it. And then we can actually pay for furnace repair, roof repair. Actually, if you lose up your job and it wasn't because you cussed out your boss, we could pay up to 3 more months of mortgage payments for you. So there's some benefits to that as well. The biggest things in this is you need to show the rent coming out of your bank account. So let's say you have a 400 credit score and it's basically all because of medical collections and things of that nature, and you can't get financed anywhere else. We need to show, well, you need to prove that you've been able to pay your rent, because your rent is going to be very indicative of how you pay your mortgage. For me, I like it if you pay your rent and you let everything else go, because that means in most cases I'll probably get my money first versus everything else. Back to the money management, no overdrafts or insufficient funds in the bank account for the last 3 months. And that actually kind of goes for all programs whatsoever. We want to see, no matter what loan program that you're on, that you can manage your money. That is a very big thing. No matter if you have a 700 credit score, you have to still show that you know how to properly manage money. For this program, a bill inspection is required. It's not required on all the other type of loans, FHA conventional, but it's highly suggested that you do, because it's going to save you thousands of dollars down the road. And then again, the mandatory savings plan for emergencies, like I talked about. So there's the mandatory home buyer counseling and budgeting form, but if you're getting the down payment assistance, you're going to use that anyway. So it's not like you have to do it twice. And like I said, it's the 80% of the median income, and you must not have owned a home in the last 3 years somewhere else. Yeah. Okay. So Monty put in the chat, what if your apartment complex only allows rent to be paid as a money order? So if you're paying like $600 in rent, what I would want to see is the ATM limit that you can do 300 coming out and then $300 coming out to get a money order, or you going into the bank and getting a money order out of the account. What's kind of hard is, let's say you're pulling out $200 one week, $200 another week, and then $200 a week after that. It makes it kind of hard to see you're paying your rent all at once. So there's ways around it. If you're pulling all the money out all at once to get the money order, we can see that through the bank statements. I hope that answered your question. Yep. Okay. Mentioned that you can't own a home in the last 3 years. A big thing on this too is your letters of explanation on all your derogatory credit. So even if something is 7 years old, you're going to have to, in most cases, on a lot of loan programs, still have a letter of explanation of why that account was paid late or why it went into collections or charge off. What we're trying to make a determination is what led to it back then, and has that situation been rectified? Was it an isolated incident, or was it a systemic problem? As I said before, the bank debits, overdrawn accounts, or return checks have to be resolved, along with like utilities. So let's say you have an Ameren bill that's $1,000 that's showing up as a collection. We're going to make you take care of that because I know you can put the bill in somebody else's name, friend name, child's name. I kind of seen it all. We want to make sure that you have the ability to put utilities in your name. And judgments and tax liens for this no credit score program must be resolved. In some cases, I can use a 12-month payment history, depending on how strong the compensating factors, meaning everything else on the file is. And seller paid closing costs. So the biggest difference. So for conventional, the maximum a seller can contribute towards your closing costs is 3%. For every other type of program is 6%. So that's kind of big. If you're buying a home for 100,000 and the seller can give you 6,000 versus 3,000. So another reason why you may want to kind of pick and choose different programs depending on how much assistance you can get and how much funds that you may need. In most cases, you have to have at least a minimum of $1,000 to get any of the assistance, which we discussed earlier. And then after all of this, the next steps I would suggest you to do is kind of ask yourself these questions. How long will you be wanting to live in the area that you want to live in? Next 3 to 5 years, 5 to 10 years? If you have children, what school district do you want to be in? Are you going to go private school? How stable is your income and employment right now, especially with COVID? And then the biggest thing is, what sacrifices are you willing to take to make your dream of home ownership come through? Because what that budget is going to dictate is, what I found out is everyone pretty much knows the rent, the utility payments, car payment, and all their fixed payments. They don't know their ancillary expenses, hair, nails, cell phone, what you spend on eating out, things of that nature. There's a two spreadsheet budget on there. It's called daily expense diaries and your fixed budget. The daily expense diaries, once you get into it, it's gonna, I call it the why I'm always broke page, because you're gonna figure out why you don't have any money if you don't have any money once you start tracking in your bank account exactly what you're spending your money on. So I'm very big on that budget, especially if it's a two-person household where two incomes in. You need to have a written budget so you both can be on a financial page, same financial page, to move forward. Because if you're not, it makes it very hard to progress. Not saying that it can't be done, it's just very hard to do so. Very, very, very hard to do so. The budget is the single most important thing in all of this. The budget is the engine that makes the car run. If you have good money management skills and you need things to address in your credit to get your credit score up, there's no way to be able to do that unless you have a budget allocated to know what you can pay towards that. If you want to go from a $600 rent payment to an $800 mortgage payment, that budget's going to dictate if you really can do it, because the budget is based off your net income. As I said before earlier, we based on what you can afford based off your gross income. That is before taxes, and no one pays their bills on before tax income. So the budget is a key essential part of this, because if you don't have that plan, and when life happens, to know what things you can rearrange based on the due date, how much it is to make the arrangements and things of that nature, it makes life just a little bit more difficult to move through. Somebody's asking, would having receipts be sufficient? No, we would need, and the reason why I say that, having receipts for rent proves that the rent was paid, doesn't mean that you paid it. Knew a lot of single women that had boyfriends or somebody else, significant other, paying their rent. If they broke up with that person, rent didn't get paid, how is it going to get paid? So we need to see the rent coming out of your bank account to make sure you're the one actually paying. And for most loan programs, they're going to want to see rent coming out of that bank statement anyway, just to prove, even though it's not a stipulation of that loan, underwriters have this thing called underwriter discretion. You're saying you were paying $1,200 in rent, and they've gotten all these bank statements for all these months, and they never see rent come out. They're going to come back and ask that loan officer. They're saying they're paying $1,200 in rent. Where's that money coming from that they're paying for? Either we have an account that we don't know about, or somebody else is paying that. So that's the reason why receipts for the rent are just not sufficient by themselves. So the next thing is, if you guys want to see what can be done, what I do is first I do what's called a soft pull on your credit, which means I pull your credit to get all 3 credit bureaus, but it doesn't show up as a hard inquiry until I know you have at least a 620 score or above to see if we can get you to those other programs. The best way for me to do that is I will put it in the chat to everyone. You go to the website and you complete the application, and I can kind of help determine where you guys are at in terms of, what it may be that you can afford, or what needs to be addressed credit wise, or all of the above. So that in a nutshell is pretty much all that I have. If you guys, let me unmute you guys. In case you guys got any questions, you can actually do that. Let's see here. So does anyone have any questions for me?
Hey, Kris, it's Jessica. Can you hear me?
Yes, I can.
So my question was, with that mandatory savings plan, if they don't use that money, is that money given back to them, or?
Yes. So because it's only for 7 years. So let's say they go the full 7 years and they don't use it, they can use it for principal reduction, home improvements, or most likely we'll do it as a principal reduction. I used to give the people the money. That could be something talked about on a case-by-case basis if they actually need the cash.
Gotcha. Okay.
Anybody else have any questions?
I have a question.
Okay.
We're going to go back a little bit. You were talking about the, hold on, other debt, right? Can you explain that a little bit for me? I think I kind of missed something.
So one thing I see in some cases, give you an example. Some people are selling the debt that's maybe like $1,000, and they set up a payment plan to somebody where they're going to pay this debt off over the 24 months. It doesn't really show up on their credit, but I see like 123. $103 coming out to like a Lexington Law or some kind of law firm or somebody like that, that's a debt that you have on a reoccurring basis that we're going to have to put into the debt to income ratio.
Okay. Thanks.
Anyone else? Joshua, did you learn something I didn't tell you before?
Yes, sir. I did.
Okay, good. Good. Anybody else have any other questions for me?
Okay, I'm back.
I have a question.
Okay.
I'll wait. Go ahead. I'm sorry.
No, you
Okay,
can go
I'm
ahead and ask your
sorry.
question.
My question. Can you hear me?
Yes, I can.
Okay, I'm sorry. My question is, if you live with your partner or something, and you guys were trying to get a home together, would you both have to go on the loan for your income to be counted?
So yeah, so you for anybody's income to be counted, they have to be on the loan and they actually have to have that property as their primary residence. There is something that's called a non-occupying borrower, which means, hey, your father may be on the application so you can use his credit for you to buy more, but he's not going to live there. That's a more trickier situation. But I would say if you guys are going to be living together, at least do the application together so I can see what needs to be taken to get you guys both approved at the same time. And then if I need to separate either one of you to make sure you can get qualified quicker, we could do that as well.
Okay, thank you.
Okay, Kris. This is just a little bit of clarity for myself. When you're talking about other debt, you said something about Lexington Law appearing on the, in their bank statements every month. Would the same apply if it's like a cell phone bill or something like that?
No, cell phone bills we don't take. So there's a lot of lots in St. Louis that are buy here, pay here. They don't report to the credit, but we can see like a $300, $350 coming out to easy car payment or, easy something like that. That's a debt we're going to have to count. Cell phone bills, utilities, and stuff like that, we don't count.
Okay. Thank you.
Hello.
Yes.
Yeah, I have a question.
Go ahead.
Do you all provide sourceable resources that will assist with the process of buying a home?
You said sourceable resources. Is that what you said?
Yes, like do you all provide resources on buying a home in areas and stuff like that? Do you all assist with that?
So
Also, making referrals basically to realtors or either things like that. I think that's what the question is.
Yeah, so different people like that, depending on, so once we get the application, I know who to refer you to, yes. So the down payment assistance programs, the first time home buyer education classes help out with a lot of that. So what I've kind of given you is a broad overview, but when you get those assistance programs, you got to take those online classes. They get a little bit more specific. So my first suggestion would be to take one of those HUD certified classes. And then if you have questions after that, I can know where to direct you further after that, if that makes sense.
Is this class, because I think I attended the class late, or I don't know, because you all were already talking when I came in, but is this class ongoing? Is this like a class, or I forgot?
So this is for people that are thinking about buying a home and just want some more information to see if home ownership is something that they want to do. So this would not be like the HUD certified classes that you would have to take to get the down payment assistance or for the no credit score program. This is just so
is there like a
sorry?
particular website or something that I have to go on to for that?
I'm putting in the website. I'm putting it in the chat right now. One is beyondhousing.org. The other one would be the Housing Partnership. And the other one would be Better Family Life. Because what they're gonna do is they're gonna pull the down payment assistance funds either from the city or the county. Just FYI, the Housing Partnership is pretty much the only organization in St. Louis that I know that deals with city funds. Beyond Housing, Better Family Life, and the Housing Partnership all deal with county funds. Now, if you're buying in Florissant, that's a totally different scenario. You would have to talk to them because I
What
know
about South County?
South County, so
so-
that's in the county. So that would be Beyond Housing, Better Family Life, or the Housing Partnership, because that is in the county. So yeah,
Those
those
are
would be
only
county
for the
funds.
local ones.
Yeah.
So there are other HUD certified classes that you can go. I'll put it in the chat too, like for frameworks. It's a little bit less inexpensive. So if you're doing FHLB funds or MHDC, you can use the frameworks program instead of the local nonprofits, because frameworks cost $75. The local nonprofits, they cost $125. So
And that does
if you
that,
do
and that
FHLB or
payment for
MHDC,
the
it's
Housing
$125.
Partnership and Better Family Life does go towards your skin in the game, the $1,000. So that 125 would be counted towards your $1,000 towards the putting skin in the game. Housing
Yep,
Partnership.
along with that 70. So pretty much anything you guys spend on the property, you want to pay by either check or debit card, so we can track it in your bank account and give you credit for it. So
Okay.
that would be the reason why I like using FHLB and MHDC. You don't have to worry about where you want to buy to get the assistance, unlike the local nonprofits that kind of, depending on where you want to buy, they may have money for you or not.
Well, I'm attending by phone, so I'm just writing down this stuff. I can't see what's in the chat.
So
what's your name?
Chris,
What's your
did you
name?
record this class?
Yes, I did.
So we will, are you gonna send it to us?
I will send you, but what's your name? Who was just speaking?
My name is Tynesha Washington.
Okay.
Okay. And okay, so did you sign up through Prosperity Connection, or did you sign up from an invite that I sent?
I really can't recall.
I got you here on my list, Tanisha. I got you. So what you can do is you can give me a call tomorrow and we can speak more in depth to give you some more questions. And like Yvette said, this has been recorded and I'll give everybody a copy of it as well.
And
it
where
will
am I
be
giving
on our
where am I
Facebook-
giving you a
our
call
YouTube
at?
page
Because
in 2 days.
Here, I will put you can't, okay, so if you're writing this down, you can reach me at 314-332-7968. And I'm also putting that in the chat for people to see as well. So if you guys got any specific questions that you don't want to
314, I'm sorry, 314-322.
7968.
You said 322-7968?
No. 332. 332.
332.
7968.
Okay.
All right. Anybody else have any questions for us before we wrap it up? Well, if not, I thank you guys for attending. My cell phone number is there. And Ms. Anika, if you call me tomorrow after 10, I should be able to answer any of your questions.
How do you preview this recordings? If you are on the phone right now, like, do I have to get on my laptop or something?
No, so what is going to happen once I get off of it, it's going to render a link, and it's kind of going to be kind of like a YouTube link. So you'll be able to watch it YouTube, and then also Prosperity Connection will have it up on their YouTube channel as well.
Okay. Do you have our email address or something? Or Are we gonna get a
Yeah,
text
so I have,
message or something?
yeah, so if you shoot me a text and let me know if you want to email or text it to you, I can do either one.
Okay.
Just depends on how you want. If I text it to you, you'll be able to see it. But if you know, I can email it to you as well. So either way.
Okay, thank you.
No problem. Well, guys, I thank you for showing up tonight. And if you got any further questions, like I said, my cell phone number is there. If you want to complete the application to see where you're at in the process to get it moving forward, we can do that. Joshua,
Yes,
continue
sir.
luck on your home search.
Thank
Hope
you.
you got some more information. And if you guys need anything else, just let me know.
I will, boss. Thank you.
No problem. You guys have a good evening.
You too.
Thank you. You have a good evening.
You too. Thanks.
Bye.
Bye-bye.